everyone, this is Todd Zempel with Gordon Asset Management here to share the fourth quarter market update and review. If you don't know who I am a partner in the firm as well as the practice leader for the Retirement Plan Services Division, clearly reporting from the home office today. Now, before we get into the presentation, a quick reminder that this presentation is intended to be for educational purposes and is not meant to be a solicitation for service or any singular product. Go ahead and read the rest of the disclosures there, and please ask if you have any questions. If you do have questions, if you would like to meet with me or anybody at our firm, you can schedule a complimentary appointment. You can do that through our website, wealthqb.com. On the website, you can find the schedule an appointment link in the top right-hand corner, and you're welcome to schedule time to talk with any of the individuals here, or feel free to shoot us an email at info@wealthqb.com. Now, quick check on the markets. Year to date, the S&P 500 index, large cap stocks, is down about 18% through the November 1st. The tech-heavy growth-oriented NASDAQ, the QQQ, down about 30% year to date. The Russell 2000, mostly small cap stocks, down about 16.5%. And on the bond front, the Barclays Aggregate U.S. Bond Index is down about 15%. And that is where the pain has primarily been felt this year, as folks that have a diversified portfolio tend to look towards the bonds to buoy the portfolio when stocks sell off. And that clearly has not happened this year. And we'll talk about that a little bit later. Now, I always do think it's important to keep things in perspective, right? Year to date, things are not good. But if we just go back in time and look at how things have performed just pre-pandemic, right? Stocks have done really well. The NASDAQ, again, net of the 30% year-to-date loss, still up 30% since 12/31/19. The S&P 500 index, again, it's still up almost 25% since that time. The Russell 2000 index still up about 15.5% since that time. And again, bonds, this is where the pain has been felt primarily. It's actually down over 10% over that two-year period of time. So again, that's been a source of pain for those that have had a diversified asset allocation. Now, when we talk about the markets, talk about the economy, I think it's really important to understand how economic cycles work, because economic cycles tend to drive market activity. So the chart on the screen shows what a economic cycle typically looks like, right? Early on in the cycle, economic activity accelerates, people work more hours, housing activity picks up, usually central bank policies easy at that point. Then as we sort of get mid-cycle towards the peak, profit margins tend to peak out, employment is really good or improves, credit demand picks up, right? People are more comfortable taking loans to make investments. Inflation is under control at that point. And then as that sort of fades out, we get late cycle. The labor market tends to tighten, costs soar, inflation sets in, profit margins contract, central bank policy tightens. And then as we leave late cycle, we head into recession. That's sort of where things bottom out. That's where economic activity declines, credit contracts, unemployment picks up. Now, the chart on the screen shows approximately where Capital Group, the company that manages the American funds, it shows where they think various countries are. They think the U.S. at this point sort of in that late cycle type area. And you can see where they feel other countries are as well. I will note that economic data tends to lag. So that is a lot of that information is backward looking. So just keep that in mind when you're looking at the chart. Now, what economic indicators can warn of a recession? There's a lot of them. And we'll go through each of these individually and give you an update on where we stand with each of them. Number one, the yield curve. So when we look at the yield on U.S. Treasuries, short-term versus long-term, if that inverts, that can be a sign that recession is approaching. Unemployment, that could be a sign. Consumer confidence, when it declines, that could be a sign. When housing starts fall off a cliff, when people aren't building homes, that tends to be a sign. And then also a basket of all those different things and other economic indicators. When we look at a basket, an index of all those things, if we track that and measure that, that can sometimes give an indicator of when we may be heading into a recession. So let's break down each one of those individually. So the yield curve. So the recession warning sign with the yield curve is when the 10-year yield is below that of 2-year yields on U.S. Treasuries. Why is that important? Often that is a sign that the Fed has hiked short-term rates too high, or investors are seeking long-term bonds over riskier assets. So it's sort of a safe haven trade. Now, the time frame, on average, it takes, once that yield curve inverts to recession actually set in, is around 14 and a half months on average. And again, if you look at that chart, it shows two lines. The gray line is the yield curve as it was positioned on December 31st, 2021. You can see there's a nice slope upward and to the right. And then the blue line shows the yield curve as of November 1st. And you can see that clearly the 2-year is around 4.5%, where the 10-year is about 4%. So clearly that is an inversion of the yield curve. And that actually occurred, that inversion actually occurred in July. So again, if we're on average, we're looking at about 14 and a half months after that yield curve inversion happens for recession to actually set in. We're kind of on recession watch according to this indicator. And again, why is this important? Well, this has been an extremely accurate measure of or predictor of when recession will set in. So the chart on the screen shows the yield curve over the last 50 years. The highlighted pink areas are where inversions occurred, and the gray sort of shaded area on the chart is where a recession actually occurs. So you can see pretty consistently before each recession, there's a yield curve inversion. And specifically, if you look at the chart on the right, you can see each year where the yield curve inverted and then the corresponding number of months it took until recession to actually set in. So again, on average, it's about 14 and a half. Sometimes it's shorter, sometimes it's longer. But nonetheless, since we had that inversion in July, we're essentially on recession watch at this point. The next indicator we'll look at is unemployment. So unemployment, when it rises from the cycle trough, that tends to be a recession warning signal. Why is it important? Well, when unemployment rises, it can lead to declining consumption and business output. That's super important because when we look at what makes up U.S. GDP, consumption makes up the biggest component of that. So if people aren't working, they're not out spending money on a discretionary basis. So clearly that would have a negative impact on the economy. And when we see that sort of bottom off the trough, it tends to be about 5.5 months after that until recession actually sets in. Where are we now? Well, this is kind of falls under the bag of mixed bag of economic data where things actually look pretty good. Clearly during COVID, a lot of wacky things happened in the unemployment area. Everybody's working from home, so a lot of people weren't working. A lot of people didn't go back to work. But nonetheless, as of now, we're at about 3.5% unemployment, which is extremely low in historic terms. The 50-year average, as you can see by the chart, is about 6.2%. So we're well below the long-time unemployment average, which I would put that in a positive bucket if we're measuring things. Now, this chart also shows wage growth in blue, so that's not an indicator, but it is important to keep an eye on this because you'll notice that wage growth tends to have an inverse relationship to the unemployment rate. And as wage growth sets in, that is an inflationary piece of data, right? So if people are demanding higher wages, that pushes the cost up of products and services, and that really helps to entrench inflation, which then feeds back to the Federal Reserve and monetary policy and bonds, and we'll talk about that in just a few minutes. Consumer confidence, the other leading indicator. When consumer confidence declines versus the previous year, that tends to be a signal that recession may be coming. Why is it important? Well, if consumers are pessimistic, they will cut back, right? If you're worried about the economy, you're not necessarily going to spend a bunch of discretionary money, go out, buy a Tesla, things like that. You're probably going to rein in the budget a little bit, and obviously that has downstream effects on the economy. When we see that decline over the previous year, it tends to be about 3 months until recession actually sets in. And if you look at the chart where we are now, we're at extreme multi-decade lows in consumer confidence. So that would be an indicator that maybe there's some storm clouds on the horizon. Sort of the silver lining in that number, though, is if you look in the top left-hand corner of the chart, you'll see how the S&P 500 has performed after consumer sentiment either peaks or troughs. So on average, the S&P 500 after consumer confidence troughs, kind of where we are now, the next 12 months in the stock market tend to be pretty good, on average up 25%, which is a little bit contrarian than what you would think. When consumer sentiment peaks out, so when everybody's super euphoric about what's going on, actually the next 12 months of the market tend not to be so great, on average about 4%. So it is a little bit of a contrarian indicator in terms of stock market, but it is a leading indicator about where the economy is headed. So keep that in mind. Housing starts, another leading economic indicator. When we see a decline of at least 10% over the previous year, that signals that recession is about 5 months away. Why is that important? Well, when economic outlook is poor, home builders often cut back, right? There's less demand to build houses, so they'll cut back, less economic activity, less jobs, et cetera, et cetera. Single family house starts in the chart in the top right-hand corner, you'll see actually kind of in line with long-term averages. Though we've seen a little bit of slowdown in the last month or two, nothing drastic yet. So I would put this sort of in the mixed bag of economic data. Yeah, we're seeing a little bit of slowdown, drawback, but nothing extreme at this point. The chart below, multifamily housing starts, also kind of off the recent high, but actually still above long-term averages, which I would say is probably bullish. And then the two charts on the left, housing inventories, you can see well below long-term average, and rental vacancy, also very low relative to the average, which says to me that there's a lack of supply in the system, which could keep housing starts up in the interim. So again, somewhat positive, but we're seeing some coming off of the highs. The leading economic index. So this is an index put together by a not-for-profit organization called the Conference Board. A bunch of really smart egghead economists from all around the world got together, and they've essentially established this index of leading economic indicators, various things. They put it all in a basket and measure it. When this indicator declines at least 1% versus the previous year, that tends to be a sign that recession may be looming. Why is that important? Well, this measure provides a broader look than some of the other things that we talked about regarding the economy. So it's not just housing, it's not just unemployment, it's kind of all these multiple things boiled down to one sort of score. Once we get that indicator, on average, it takes about 3.5 months for the economy to slide into recession. As you can see by the chart, we received a warning signal and sort of a confirming signal that the economy may be headed into recession in September. So again, we're kind of on recession watch per this metric. Now, those were the leading economic indicators. But keep in mind as well that the stock market itself is a leading economic indicator. The stock market itself has tended to bottom before the worst of the economic news has comes in. I'm not going to go through each one of these charts, but just know that they each represent a recessionary time frame. And then the blue line, the dotted blue line, is the S&P 500 index. So think the stock market, whereas the red line is stock earnings, the dark blue is payroll data, and then the yellow line is GDP data. That's broader economic data. And you can see pretty much without fail, the stock market sees the recession coming, sells off ahead of the worst economic data, and then on the reverse tends to rebound before the economic data actually turns around. So that's a pretty common thing that we see. And then over on the next slide, you can see the more recent recessions, similar kind of fact pattern with the exception of the dot-com bubble burst. So in that situation, stocks continued to sell off after the worst of the economic data came out, and then continued to sell off really after the better economic data started to come in. Why is that? Well, that was sort of a major price correction. If you guys remember pets.com, everybody buying up stocks to ridiculous multiples, that was very much a pricing correction with the market, not so much a major recession in terms of GDP, economic output, small one. Now, where are we today with those metrics? Well, you can see on the chart, stock market is selling off. Is it the bottom? Who knows? It's hard to tell. But the economic data, some of it is starting to roll over. Again, earnings are starting to roll over. GDP is kind of slowing, but the payroll data is still pretty strong. The employment market is still really healthy. So again, it's sort of a mixed bag at this point. This chart shows the calendar year returns in the S&P 500 alongside the peak to trough max drawdown in any given year. You can see year to date, the S&P 500 index at max drew down 25%. Right now, we're kind of down 18, 19%, depending on the day. And you can look at the data over each year going back to 1980. And you can see we had some pretty big drawdowns in those years. I think it's fresh enough in everybody's mind to remember 2020 during COVID. The market was actually down 34%, which was extremely painful, much more than this year. But it actually ended the year up 16%. And you can look at year by year how things have played out. But I think the takeaway here is that despite intra-year drops averaging about 14%, which don't get me wrong, 14% drawdown is a big number. But despite that, annual returns have been positive in 32 of 42 years. So that sort of illustrates that the stock market has this natural gravitational pull upwards. And I think there may be a philosophical debate on why that is. American exceptionalism, capitalism, humans' desire to grow and flourish. Who knows? There's a lot of philosophical discussions and reasons why that may be the case, but nonetheless, it is what it is. Clearly, it's in the data. Now, this chart shows the same layout, intra-year drawdowns versus calendar year returns, but in the bond market instead of the stock market. As I mentioned, this has been the most painful year in bonds in pretty much recent history. And clearly by the chart, you can see that with the bond market being down around 17, 18%, and we're kind of sitting at the lows or just off the lows, depending on the day. Clearly, this is the 100-year flood, right? This has not happened in many, many decades. You can see the stat there at the top. Despite intra-year drops of 3.1%, annual returns have been positive 42 of 46 years. So over 90% of the time you've had positive returns in bonds, and the drawdowns in bonds hadn't typically been super painful. And that is why when people construct investment portfolios, you hold both stocks and bonds, right? You want the bonds to be there when the stocks sell off to provide you to help buoy your portfolio when really bad things happen. But that has not been how things have played out this year. And that's, again, why people that are doing the right thing, having a diversified portfolio, rebalancing, that is why things have been particularly painful. And even folks that are close to retirement. So as you are younger, you'll tend to hold more stocks, looking for more upside. You have more risk tolerance. But as you get closer to retirement, folks tend to rotate out of stocks into bonds. And so a lot of people that are close to retirement or in retirement will hold more bonds. So this has been exceptionally painful for folks in that situation. Now, why is the bond market suffering this year? Well, there's many reasons for that. The primary one is quantitative tightening. So quantitative tightening is the process of monetary restriction. So right now, inflation has perked up. It's been very subdued for a very long time, several decades. But in the last year, it's really bubbled up. You can see it on the numbers on the chart. Headline CPI, Consumer Price Index, 8.2%, core is 6.3%. And then really where a lot of the inflation is seen is in food and energy. You can see up 11%, energy up almost 24%. So as we've seen this inflation, the Federal Reserve, the U.S. Federal Reserve, has raised interest rates. And essentially what their goal is to do is to slow down the economy, cool things off so inflation fades and we have more price stability. So the Federal Reserve is intentionally trying to slow down the economy. So when we look at all these leading economic indicators about where things are headed, yeah, clearly the economy is slowing down. That is the Federal Reserve's goal. I know it's not super politically convenient for politicians to say, hey, our goal is to slow down the economy and blow up the stock market. Yeah, you know, they're never going to say that, but you know, their goal is to slow down the economy. So until we see inflation fade, we can count on the Fed continuing to be very hawkish with regard to inflation, which means they'll continue to raise interest rates until either something breaks in the economy or we get inflation back under control. Now, there's some signs that in some areas, inflation is sort of peaking and trailing off, but in other areas, primarily, again, food and energy, you know, there's a lot of reasons to think that inflation there may indeed be persistent. Again, thinking back to that wage slide, you saw that wage growth was ticking up as well. Again, that's one of those things that once people start getting paid more, it's kind of a hard thing to undo, short of blowing up the economy and sending the economy into recession and having to lay off a bunch of people. So potentially wage growth could help entrench secular inflation. Now, you know, we talk about recessions and what's going on in the market, but again, as I mentioned, you know, the market and the economy has this natural gravitational pull towards growth. And this chart really illustrates that. So this chart is cumulative US GDP over various time periods dating back to the 50s. So what I really love about this chart, so the greenish blue color show during periods of expansion shows GDP growth. Just think of that as economic growth. And then the kind of pinkish purplish color is slowing growth, decelerating growth during periods of recession. And as you can see over time, the average expansionary period is about 69 months. We experience about 25% growth and add about 12 million jobs over the average expansionary period. In the average recession, it lasts about 10 months. GDP growth declines by about 2.5%. We lose about 4 million jobs. Don't get me wrong, that's super painful, and especially for somebody that lost their job. But as you can see over time, clearly there's this natural gravitational force, this pull towards expansion and growth, at least here in the US economy. So this is a great reason why we advise people to stay invested. Sure, you can overweight certain sectors or hold a little bit more cash occasionally, but over the time, it's really hard to invest in an all-in or all-out kind of mentality, right? Slight overweights and underweights are perfectly fine, but playing the game of being all in or all out, that can be a fool's game. Now, again, we sort of have this mixed bag of economic data, some good, some not so good, but clearly the Federal Reserve, through quantitative tightening, is trying to slow things down. So how do we position things, portfolios, when the market declines? I love this chart because it shows how the various sectors in the index, S&P 500 index, perform during market declines. So over the last 10 stock market decline periods, you can see consumer staples, think food, grocery stores. Consumer staples outperform the average, the index, 10 out of 10 times, right? Because people are not going to stop going to the grocery store to buy food, clearly. Utilities. So utilities outperform the average 9 out of 10 times. Again, people are probably going to try to pay their electric bill, even during a recession. Healthcare outperformed 9 out of 10 times. Again, you got to go to the hospital, you got to go to the hospital. Telecom, your phone. You know, I'm plugged into my cell phone, so that would probably be pretty low on the list to get cut as well. Energy, that's more half and half, right? As the economy slows, less energy will be used, less diesel fuel to traffic goods around and whatnot. Materials, you can see that underperforms 6 out of 10 times. Consumer discretionary, people aren't spending as much on discretionary items when sort of the fate of the economy is unclear. Technology, financials, industrials, again, lower production of things in recessionary times. So those sectors are areas that we like and have tended to do well during times of uncertainty. What's really interesting about those sectors is if you look on the right-hand side, you can see the dividend yield of those various sectors. Those various sectors tend to have higher dividend yields. And that sort of makes sense, right? If you have a business that is resilient during recessionary times or market downturns, you're going to feel better about paying shareholders back rather than holding on to that cash just in case things really head south. So that is kind of an interesting factoid there. Now, just to recap things, right? So we have this mixed bag of economic indicators that indeed are showing signs of deterioration. Again, it's mixed bag, some good, some not so good, but we're seeing some coming off of recent highs. And also the Fed is hell-bent on curbing inflation by dampening economic demand. Like I said, their goal is to slow things down in order to get inflation under control. It's not politically convenient to say the Federal Reserve wants to blow up the stock market and slow down the economy. But, you know, that's kind of what they're trying to do. And really, until inflation abates, if inflation goes away, I'd expect tight monetary policy. If we do see inflation trail off, which could absolutely happen if we enter into a recession, if economic activity slows down, yeah, inflation is going to slow down as well. And they could unwind their tight monetary policy pretty quickly. So that's one of the things we're watching for. Also, remember that the market is a forward-looking mechanism. It tends to bottom before the worst of the economic data comes out and rebounds more quickly than the data would suggest. So I know the interim sort of period, the next 6 months to a year, there's a lot of storm clouds on the horizon, but you could there's a very good chance you may be watching the stock market rally like crazy when you're watching the news and you're seeing reports of layoffs occurring, unemployment jumping up. So be on the lookout for that. And then again, in terms of portfolio positioning, we like themes of high quality, strong balance sheets, earnings clarity. Again, thinking about those sectors, consumer staples, utilities, things that people will continue to purchase regardless of what's happening in the economy. Those things tend to hold up better than the broader market during market decline. So that's where we would look to position. Also, if you're following the market, you'll know that growth stocks have just absolutely done terribly. You saw that with the NASDAQ underperforming the other US stock markets. But there's been this move out of growth into value-oriented funds. And that really started probably close to 18 months ago and has really accelerated as I think a lot more people are starting to see signs of potential recession on the horizon. Again, we'd kind of expect that to continue until we enter into a potential recession. And then again, the stock market's a forward-looking mechanism, so we'd look to deploy some of the cash that we've set on the sidelines or saved up or not put to work because we would expect the stock market to start turning around before much of the economic data does. So if you'd like to learn more about our firm, we encourage you to check out our podcast. It's called the Gordon Asset Management Podcast. You can find it anywhere you listen to podcasts. We have a great YouTube page, also our website. And again, if you would like to reach out, if you have questions, visit our website, wealthqb.com, schedule a complimentary meeting with us, shoot us an email, give us a call, follow us on social media. So that'll do it for today, folks. I appreciate your time and thanks for joining me. And we look forward to the next one. Thanks.